Silver is quietly testing the plumbing of the global liquidity system again, and almost nobody is asking the right question. This is not about excitement or dramatic headlines. It is about delivery mechanics, leverage, and what happens when paper positioning meets physical constraints. Our strategy approaches this through sequence, not spectacle. When Comex silver inventories decline into a major expiration window, the mechanism that matters is not whether everyone suddenly demands delivery. It is whether margin structures, roll behavior, and dealer positioning absorb the pressure or amplify it. Most contracts are rolled. Most stress resolves quietly. But when inventory drawdowns accelerate into expiration, the probability of reflexive positioning increases. That reflexivity, not the metal itself, is what can move price. At the same time, we are seeing stronger investor interest in precious metals and persistent central bank accumulation in gold. That does not create immediate instability, but it does change the background regime. It increases the structural bid under real assets during periods of policy uncertainty. The key question is whether structural demand is being misread as imminent squeeze dynamics. Within our framework, we classify this environment as late phase 1 with rising phase 2 pressure. Liquidity has not broken. Credit stress is not acute, but rotation and positioning are more fragile than they appear. The probability that silver experiences continued elevated volatility into the next expiration window is approximately 60% over the next 4 to 6 weeks. The probability of a systemic short squeeze event that disrupts broader funding markets remains closer to 20% in that same window. If that probability rises, it will not be because of social media narratives. It will be because of confirmed delivery strain combined with widening credit spreads and funding stress across markets. Meanwhile, equities are attempting stabilization after months of defensive rotation. Breadth has improved modestly. Options positioning shows defined support zones beneath current index levels, creating local stability but also defining fragility if those levels fail. If you find value in breaking markets down through mechanisms rather than headlines, consider subscribing. We focus on phase progression, signal alignment, and structural risk so you can better interpret what markets are actually doing beneath the surface. In this environment, we react to flow rather than predict outcomes. If silver breaks to sustained higher highs with expanding volume and open interest, that confirms structural demand. If it fails and retraces on declining volatility, that suggests positioning exhaustion rather than systemic stress. In equities, continued holds above major support zones keep phase 1 intact. A decisive breakdown through those levels would raise phase 2 probability into the summer of 2026 toward roughly 50%. For now, the higher probability path remains controlled instability rather than collapse. Oil strength, dollar stabilization, and mixed yield behavior suggest the system is strained but not fractured. Bitcoin is consolidating within a high demand structure. If liquidity remains stable and dollar pressure eases, that asset can reassert liquidity beta behavior. If funding stress emerges, correlations can temporarily converge. This discussion is for educational purposes only and reflects a probability-based macro framework, not financial advice. The discipline remains consistent. Observe the transmission channels. Separate narrative from mechanics. Let sequence, not emotion, determine phase progression.